You know those PPO insurance plans? They always talk about the freedom to see any doctor you want. It sounds amazing, right? But those out-of-network benefits, well, they can hide some really nasty financial traps. Today, we're going to pull back the curtain and show you exactly what's going on. So you look at your plan and it says right there in black and white, out-of-network care is covered. But the real story, the one that actually affects your bank account, is buried deep in the fine print. And it all boils down to this one single, often hidden number that can make or break your entire benefit. To really get our heads around this, let's think about your healthcare year as a kind of financial journey, like a road trip. It has a starting line, some milestones along the way, and a finish line. If you understand this map, you can avoid all those painful, expensive surprises. Okay, so our journey has three main phases. First, you've got to meet your deductible. After that, you get into the coinsurance phase, and finally, you reach the finish line, hitting your max out of pocket. So let's break down what each of these really means for you. So at the very beginning of the year, it's all on you. You're paying 100% of your out-of-network bills. You get these detailed invoices from your doctor. They're called super bills, and you send them over to your insurance company. They use those to track how close you're getting to your deductible. Seems simple enough, right? Well, hold on, because this is exactly where things start to get tricky. And this brings us to the big one, the hidden rule that completely changes the game. It's called the usual and customary fee. And believe me, it is the most important and frankly, the most frustrating part of this entire system. So what is this UCF? You can think of it as a secret price tag. It's the absolute maximum amount your insurance company has decided a service is worth. And here's the kicker. They decide this number, not your doctor. And a lot of the time, you have no idea what that number is until after you've already submitted your first claim. And this creates this massive gap. Your doctor charges what the service actually costs, but your insurance company only even looks at the amount they think is reasonable. The difference between those two numbers, that comes straight out of your pocket. And get this, it often doesn't even count toward your deductible. And you can see why people get so angry about this. I mean, listen to this. This just perfectly captures the frustration. When you find out that your insurance company's reasonable fee is a tiny, tiny fraction of what a service actually costs, yeah, it doesn't feel like a benefit. It feels like a total scam. And the difference between a good plan and a bad one here is just staggering. A decent plan from a big commercial insurer might set their UCF at something fair, like 120% of what Medicare pays. But these other plans, they might set it at just 10% of the Medicare rate, which basically makes your out-of-network benefit completely worthless. All right, so let's say you finally chipped away at that deductible UCF shenanigans and all. What happens next? Well, now you venture the home stretch. This is the coinsurance phase, and it's what gets you to that finish line, your max out of pocket. So during coinsurance, your insurer finally starts chipping in. They might cover, say, 50%, but, and this is a huge but, they're only paying 50% of their usual and customary fee, not 50% of what your doctor actually bills you. So you're still stuck paying the other 50%, plus the entire difference between that low UCF and the real bill. This process just keeps going and going until you finally hit that finish line. And for our example today, let's say that magic number is $9,000. That's it. That's your maximum out-of-pocket limit for the whole year. It's the most you're supposed to spend. And this, my friends, is where things finally turn in your favor. Once your spending hits that max, your insurance company starts paying you back for 100% of their usual and customary fee for every single service for the rest of the year. Now, you might still have to pay the difference if your doctor charges more, but this can still slash your costs enormously. Okay, so now that we know how this trap is set, how can we flip the script? How do we turn this system from a trap into a tool? Because once you know the rules of the game, you can actually play it strategically and get the most out of your plan. See, this kind of plan actually becomes like a superpower, but only under very specific conditions. It works if you know you're going to have a lot of healthcare costs that year, if your plan has a reasonable max out of pocket, and if you can plan to hit that limit as early in the year as possible. For example, think about a high-use treatment like psychoanalysis. You might be seeing a therapist 3, 4, even 5 times a week. With that kind of regular, predictable expense, you can blow through your deductible and hit your max out of pocket super fast, sometimes within the very first month of the year. And once you do that, it's like a switch just flips. The plan's real value is suddenly unlocked. You've paid your share for the year, and now the insurance company is picking up the tab for the rest of your care based on their UCF, all the way until December 31st. And just think about the value here. Let's use the example from our source. After you spend your $9,000 out of pocket, your plan could end up paying out $60,000 for your therapy for the rest of the year. That is a massive return on your investment in your own health. So I'll just leave you with this final question. You know what you pay every month in your premium, right? But do you know your plan's usual and customary fee? Do you know what its real value actually is? Finding that out could literally save you thousands of dollars. Thanks for digging into this with me.